Look carefully at these two trade setups. Both charts contain what appears to be a strong bullish engulfing candle. Setup A produces a clean upward move. Setup B fails shortly after the entry and hits the stop loss. So, what made the difference? It was not the candlestick pattern. One setup had three important price action concepts working together. The other had only an attractive looking candle. By the end of this video, you will know exactly which setup was valid, and, more importantly, why. Most beginners make price action far more complicated than necessary. They try to memorize dozens of candlestick patterns, chart formations, and entry techniques. But a simple price action decision can be built around only three questions. First, what is the market doing? Second, where is price currently located? Third, has price provided a valid reason to enter? These questions represent the three concepts we will study: market structure, key levels, and entry confirmation. When all three agree, we may have a trade setup worth considering. When one is missing, waiting is normally the better decision. This video is for education only. It is not financial advice or a promise of trading profits. Every strategy can produce losing trades. Use a demo account while learning. Test every method for yourself, and never risk money you cannot afford to lose. Now, let us begin with the first concept. Concept number 1 is market structure. Market structure tells us whether price is generally moving upward, moving downward, or moving sideways. In other words, it gives us direction. We do not need an indicator to identify it. We can read it directly from the swing highs and swing lows on the chart. In an uptrend, price generally creates higher highs and higher lows. A higher high forms when price moves above the previous important high. A higher low forms when a pullback remains above the previous important low before buyers take control again. This sequence tells us that buyers are still willing to purchase at increasingly higher prices. When the structure is clearly bullish, beginners should normally concentrate on buying opportunities rather than trying to predict the top of the market. A downtrend is the opposite. Price creates lower lows and lower highs. A lower low forms when sellers push price below the previous important low. A lower high forms when a recovery fails beneath the previous important high. This tells us that sellers remain in control. In a clear bearish structure, looking for selling opportunities is generally simpler than repeatedly attempting to catch the bottom. The third condition is a range. In a range, price is not consistently creating higher highs or lower lows. Instead, it moves between an upper boundary and a lower boundary. This is where many beginners become confused. They see a bullish candle and assume an uptrend has started. Then they see a bearish candle and immediately change direction. But individual candles do not define the overall market. Structure does. If the chart looks confusing, zoom out. Important swing points become easier to identify when we stop concentrating on every small candle. Ask this simple question: is price making progress upward? Is it making progress downward? Or is it repeatedly returning to the same area? Upward progress suggests bullish structure. Downward progress suggests bearish structure. Repeated movement between two boundaries suggests a range. Market structure gives us direction, but it does not tell us exactly where to enter. A beginner may correctly identify an uptrend and still lose money by buying after price has already moved too far. That takes us to the second concept. Concept number 2 is the key level. A key level is an area where price previously produced a meaningful reaction. It can act as support, resistance, or a supply and demand area. The important word is area. Support and resistance are rarely perfect, single price lines. Price may move slightly through a level before reacting. This is why drawing a narrow zone is often more practical than expecting a perfect reaction from one exact price. Support is an area where buying pressure previously became strong enough to stop or reverse a decline. Resistance is an area where selling pressure previously became strong enough to stop or reverse an advance. However, We should not mark every minor turning point. If the chart contains 20 different lines, the analysis will not help us make a clear decision. Focus on areas that meet at least one of these conditions. Price reacted strongly from the area. The area created a clear change in market structure. The level has been respected more than once, or the area is visible on a higher time frame. The strongest levels are usually obvious without needing to force them onto the chart. Imagine that the euro versus the US dollar is producing higher highs and higher lows. We have established that the broader structure is bullish, but buying immediately after a large bullish movement may give us a poor entry and an unnecessarily large stop loss. Instead, we can wait for price to pull back toward an important support area. Now direction and location begin to agree. The structure is bullish, and price has returned to an area where buyers previously entered the market. This does not guarantee that support will hold. A level is not a wall. It is only a place where we become interested in what price does next. That distinction is essential. Beginners often enter the moment price touches a line, but touching a level is not the same as respecting it. We still need evidence that buyers or sellers are responding. That evidence comes from concept number 3. Concept number 3 is entry confirmation. Confirmation is the behavior that tells us price may actually be reacting to our key level. There are many possible confirmation techniques, but beginners do not need to memorize all of them. We will concentrate on 3 simple forms: a strong rejection candle, an engulfing candle, and a break followed by a retest of minor structure. A bullish rejection candle forms when price moves lower but is pushed back upward before the candle closes. The lower wick shows that sellers attempted to move price down, but buyers responded. However, a rejection candle in the middle of nowhere is not automatically a buy signal. Its location matters. A bullish rejection at an important support area within bullish market structure has much more meaning than the same candle appearing after an extended move or directly beneath resistance. A bullish engulfing candle occurs when buyers produce a strong candle that covers the body of the previous bearish candle. Again, context is more important than appearance. The candle becomes useful only when it supports the broader story being told by structure and location. The third confirmation is a minor structure break followed by a retest. Suppose price enters support and initially continues to create small lower highs. When buyers finally push above the most recent minor high, short-term momentum may be changing. If price then retests that broken area and holds, the reaction may provide a more conservative entry. This approach will sometimes produce a later entry. It may even cause us to miss some trades. But missing a trade is not the same as losing money. Beginners frequently believe they must capture every market movement. They do not. The objective is simple: follow a repeatable decision process. Before considering an entry, ask: is the market structure clear? Is price located at an important area? And has price shown confirmation? If the answer to one of these questions is no, the setup is incomplete. Let us combine all 3 concepts in a complete example. We are looking at a historical 4-hour chart of the Euro US dollar. First, we identify market structure. Price has produced a higher low, followed by a higher high. The next pullback remains above the previous major low, and buyers create another higher high. The market structure is therefore bullish. This does not mean we buy immediately. It only tells us the direction we prefer. Second, we identify a key level. The most recent upward movement began from this area. Price left the area with strong bullish candles and later broke above the previous high. Instead of drawing a thin line, we mark a small support zone around the base of that movement. Now we wait for price to return. Price begins to pull back. At this stage, some traders may enter too early because they are afraid of missing the next upward move. But we have only one concept supporting the entry: bullish structure. Price has not yet reached our preferred location. We wait. Price now enters the support zone. We have bullish structure and a key location. but we still do not have confirmation. A level can fail, so we allow price to show us whether buyers are actually responding. A rejection appears inside the zone. The next candle closes strongly upward and engulfs the body of the previous bearish candle. Now, all three concepts agree. The structure is bullish. Price is reacting from support, and buyers have provided confirmation. A possible entry can be considered after the confirmation candle closes. The stop loss belongs below the support zone and below the rejection low. It should not be placed at a random distance, simply to create an attractive risk to reward ratio. That area represents the point where our trade idea would be invalidated. If price moves decisively below the zone, the expected bullish reaction has failed. A logical first target is the previous important high. This is an area where price may encounter selling pressure again. Before entering, we can use TradingView's long position tool to compare the distance to the stop loss with the distance to the target. If the potential reward is too small relative to the risk, we do not move the stop loss closer just to make the numbers look better. We have three choices. Identify a better target. Wait for a better entry. Or avoid the trade. In this historical example, price respects the support area and moves toward the previous high. But remember, a correct process will not make every trade win. The purpose of the framework is not to predict every candle. It is to remove weak, impulsive and poorly located entries. Here are 3 mistakes beginners make when using this framework. Mistake number 1 is identifying structure from only the most recent candle. One large bullish candle does not automatically create an uptrend. Look at the sequence of meaningful swing highs and swing lows. Mistake number 2 is drawing too many levels. If every price is treated as support or resistance, no level is truly important. Keep the chart clean and concentrate on the areas that produced obvious reactions or structural changes. Mistake number 3 is treating confirmation as a guarantee. A rejection candle, engulfing pattern or structure break can still fail. Confirmation only provides evidence. It does not remove uncertainty. That is why every setup still needs a logical stop loss and controlled position size. A strong setup with excessive risk can still seriously damage an account. Now let us return to the 2 charts from the beginning. Both contain a bullish engulfing candle, but only one contains a complete price action setup. Setup A appears during bullish market structure. Price has pulled back into a previously respected support area. The bullish engulfing candle provides confirmation that buyers are responding from that area. Setup A therefore contains all 3 concepts: direction, location, and confirmation. Now examine setup B. The bullish engulfing candle looks impressive, but the broader structure is bearish. It also forms in the middle of the chart rather than at meaningful support. The candle is fighting market's direction and has no strong location behind it. Setup B contains a pattern, but it does not contain a complete trading idea. This is why memorizing candlestick shapes is not enough. Before your next price action entry, ask 3 questions. What is the market doing? Where is price located? And what has price done to confirm the idea? Market structure provides direction. The key level provides location. Confirmation provides the possible entry trigger. If these 3 concepts do not agree, remain patient. Open TradingView, select one major forex pair, and find one historical example where all 3 concepts appeared together. Mark the structure, draw the key level, then highlight the confirmation candle. Do not begin by searching for an entry. Context is what gives price action its meaning. Begin by building the complete story behind the trade, because the best looking candle is not always the best setup.